Hi everyone, welcome back. So in this session, let's continue our discussion on calculating IRR, but now we're going to do it under the second method. The first method, like we saw, was the Excel method of computing IRR. I'm going to continue the same example to show you how we calculate the IRR under the second method. Now let's assume Gajni. Actually, let's not assume. I am actually a Gajni. I do not remember the IRR that I calculated under the method 1. All right. So I'm starting on a completely clean slate. Now, all I have is this piece of information, and I'm going to start calculating XIRR or IRR on the basis of trial and error method. So like we saw, I have a cash outflow of 900 today, which is nothing but the market price of the bond. And then I have a cash inflow of coupon of $80 at the end of each year for a period of 4 years. And then at the end of year 5, I receive the redemption value, which is $1,000 plus the coupon for the 5th year, which is 80, thereby totaling to 1,080. All right. So now if you actually see in the form of coupon, I'm receiving a return of 8% every year. And then I'm also having a capital gain. The reason is I'm buying a bond at 900 and then I'm getting a redemption value equal to 1,000. Therefore, I'm having a capital gain. Right? So I have a coupon of 8% and then I have a capital gain. So obviously the return that I'm earning is greater than 8%, correct? Because my revenue return, which is nothing but the coupon, is 8%. And then in addition to that, I have capital gains. So obviously my return or the rate of return that I'm earning from this investment is greater than 8%. So what I'm going to do is I'm now going to discount all these cash flows at say 9%, because I know that the rate of return should be, the IRR should be greater than 8%. I'm just adding 1% extra and I'm now discounting these cash flows using 9% IRR. Let's see what the result is. Using 9% as the discount rate, I mean. So I'm calculating the present value factor at 9%, which is nothing but 1 divided by 1 plus R whole power n. And now if I calculate the discounted cash flows, which is nothing but cash flow multiplied by the respective present value factor, and if I just take a total of it, I'm then calculating NPV. Now, before I click the enter button, if 9% is actually the IRR, then the NPV should actually be equal to 0. Okay, if 9% is actually the IRR, the NPV should actually be equal to 0. Now I'm just pressing enter. NPV is actually $61. Okay, the fact that NPV is not equal to 0 means that this is not the IRR. All right, so the NPV is positive 61.10. The fact that NPV is not equal to 0 means that the 9% is not the IRR, right? So now I'll have to try some other discount rate as the IRR. Now I'm just increasing 9. So now if you actually see, I have a positive NPV and I have to reduce the NPV to 0. My target is to bring the NPV down to 0. All right, to bring the NPV down to 0, I need to increase the discount factor, right? Because NPV and discount rates are inversely correlated. When discount rate goes up, NPV falls down, right? So I want the NPV to fall from 61 to 0, and therefore I'm increasing the discount rate by, let's say, 0.5%. I do not actually know how much it should be increased by. I'm just doing it by trial and error. The fact that the name of the method is trial and error means that I'm just doing it. I'm just making a random ad hoc adjustment, right? So now I'm going to discount these cash flows by 9.5%. Then let's see what the resulting answer would be. So this is now 1 divided by 1.095 whole power n. I'm just, yeah. Now again, I'm calculating the discounted cash flow as nothing but the actual cash flow multiplied by the respective present value factor. And again, I'm just putting the formula of equal to sum and I'm calculating the NPV. Now, if this NPV is actually equal to 0, then it would mean that 9.5% is actually my IRR, because our definition of IRR is nothing but it is the discount rate at which the NPV actually becomes 0. Now let's see what the NPV is. the NPV is actually still positive. It is positive by $42. Okay. But if you actually see, the NPV has gone down. It has come down from 61 to 42 when I've increased the discount factor from 9 to 9.5. All right. So now I want the NPV to actually further reduce. Okay. I want the NPV to further reduce from 42 to 0. All right. I know that, by decreasing it by increasing the discount factor by 0.5 percentage, NPV has actually gone down only by about $20, right? Approximately it has gone down by $20. Okay. So I know that if I increase it from 9.5 to 10 percentage, again, the decrease is going to be approximately by $20 only, right? It won't be exactly the same, but it's going to be approximate. So it will be actually foolish of me to actually discount all these cash flows by 10% again. So instead, what I'm doing is I'm now discounting these cash flows at 10.5%. Okay. So now my method of logic was, when I increase the discount factor by 0.5%, the NPV only reduced by $20. I want the NPV to reduce by $42, right? So that is the reason, instead of again increasing the discount factor by 0.5%, this time I'm increasing the discount factor by 1%, thereby making it present value factor at 10.5%. All right, now let's just see how the answer is. Present value factor at 10.5%, and then again the discounted cash flow. Okay, 1 divided by 1.105 whole power n. And now I'm calculating the discounted cash flows as cash flow multiplied by the present value factor. And now I'm again using the formula equal to sum. And this time you again know the logic. If this is equal to 0, then it means that 10.5% is my IRR. 10.5% is the rate of return that I earn on this investment. Okay. I'm hoping that it becomes 0. Let's see how it is. It is still positive, but it is positive only by $6. Okay. So it is when the discount rate is 10.5%, my NPV is equal to $6. My target NPV is that it should become 0, right? So I still have to further, 10.5% is still not my IRR, but I still have to increase this 10.5% by a certain amount. Only then I will get my NPV as exactly equal to 0. And that will be the exact IRR or the exact rate of return that I am earning on my investment. Okay. Now, again, if you remember, when I increased it from 9 to 9.5, it got basically reduced by about $20, right? So again, if I actually increase from 10.5 to 11, the NPV will actually become probably minus 15 or something like that. Okay, let us actually see how it is when I discount it at 11%. I'm expecting it to be somewhere around minus 15 or somewhere around that range. Okay, let's just quickly see. So I'm discounting it at 11%. Again, I'm using the same formula, 1 divided by 1 plus r whole power n. And then I'm multiplying the cash flow with the respective present value factor. Okay. And now I'm basically taking the NPV of this again. I'm reasonably sure that it will be somewhere about negative 15 or 14. Okay, it's negative 11. Okay, I probably overestimated it. It is about negative 11. Okay, so a discount factor of 10.5% is giving me a positive NPV of 6.4. A discount factor of 11% is giving me a negative NPV of 10.88. My target NPV is 0 because IRR is that rate of return at which NPV is actually equal to 0. If you discount all the cash flows at IRR, the NPV will become equal to 0. Okay. So my target is to find out that discount rate where NPV is actually equal to 0. And that discount rate is going to lie between 10.5 and 11. It's going to lie somewhere between 10.5 and 11%. Okay, so now I apply a simple interpolation, what I also referred to in the capital budgeting example, where I said that we interpolate. We are actually applying that interpolation over here. What we are going to say is, I have increased the discount factor by 0.5%. I've increased the discount factor by 0.5%. When I increase that, my NPV has actually fallen by $17. When I increased the discount factor from 10.5 to 11, my NPV fell down by $17. How is it $17? I had a positive NPV of $6, and now I have a negative NPV of negative NPV of 10.88. Therefore, my NPV has actually fallen by $17. I want my NPV to actually fall by 6.43. Because I have a positive NPV of 6.43, I want that to just become zero. When I'm saying that, I want my NPV to actually just fall by $6. Okay, so I'm just pressing 6.43 over here. I had, when I increased the discount factor from 10.5 to 11, that is when I increased the discount factor by 0.5%, I had a decrease in NPV of 17.31. I want a decrease in NPV only of about 6.43. Therefore, how much should I increase the discount factor by? This is nothing but your unitary method, or this is also called as interpolation, right? So all we will do is 6.43 divided by 17.31 into 0.5. Okay, it's just a unitary method, right? So it will be basically 6.43 divided by 17.31 multiplied by 0.5%. The answer is, let me just add the decimal. So it is saying that I need to increase my discount factor by 0.19% to ensure that my NPV becomes zero, which in other words, instead of increasing the discount factor from 10.5 to 11, I need to increase it only by 0.19% to ensure that NPV will actually become to zero. When I'm saying that I should increase it by 0.19%, obviously what is the discount rate going to be? 10.5 plus 0.19%. I'm again adding the percent, sorry. Okay, it is 10.5% plus 0.19%, which is nothing but 10.69%. Okay, if you actually see in the previous where I used the Excel formula, I had an answer of 10.68%. Over here, I'm having an answer of 10.69%. This is also slightly getting rounded off. Reason being, I have assumed that 0.5% increase is directly resulting in a $17.31 decrease in NPV, whereas actually NPV and discount rate are not linearly correlated, right? They're exponentially correlated. Therefore, assuming linearity is actually incorrect, and therefore there's going to be slight approximation, which we are completely okay with. Okay. And if you actually notice, if I discount all these cash flows by 10.69%, there will still be a slightly positive or slightly negative NPV, because this is not absolutely correct. Okay, because like I mentioned, this is just a slightly approximated. Okay, the right answer is actually 10.68%, but we are slightly approximating it. I'm just quickly solving it. Let me just so the present value factor at 10.69%. Okay, let me actually take it up to the third decimal. It is 10.686%. And now let's calculate the discounted cash flow. It is nothing but 1 divided by 1 plus R whole power n. Okay, now if I actually calculate the NPV, see, it's slightly negative. It's not exactly zero. It is minus 0.06, which means that this is just, I mean, it's approximated almost to the last digit. Okay, if you actually see, the answer that we got over here is 10.679, and the answer that we got over here is 10.686%. Okay, so it's actually not perfectly correct, but it's reasonable approximation that we can deal with. Okay, the NPV is hardly negative, so we are okay with this level of approximation. Okay, now if I quickly recap our thought process, what we saw was, initially the coupon is 8%, therefore my return is 8%. But in addition to the coupon rate, I am also receiving a capital gains, right? So my return is obviously going to be greater than 8%. And on a random basis, because the name of the method is itself called as trial and error method. On a random basis, I just chose 9% and I calculated the present value factors. I realized that we still have a positive NPV and I kept increasing the discount rate. Okay, I first increased the discount rate by 0.5% and then I increased the discount rate by 1%, guessing that, because the first 0.5% did not result in a significant decrease, right? So guessing that, I just increased it directly by 1%. I still had a slightly positive NPV. And this time I again increased it by 0.5%. And then I basically got a negative NPV, and I realized that my IRR will be lying between 10.5 and 11%. And then I applied the linear method, or the simple binary method that we generally use, where I said that 0.5% increase in discount rate has resulted in a decrease in NPV of 17.31. I want a decrease in NPV of only 6.43, right? I want the NPV to go down from 6.43 to 0. Therefore, my target reduction is 6.43. Therefore, how much should I increase the discount rate by? This is nothing but your pure linear method, okay, unitary method. So the formula is 6.43 divided by 17.31 multiplied by 0.5%. The answer is 0.19% or 0.186%, which means that my IRR is nothing but 10.5 plus 0.186%, which is 10.686%. And I showed you that when I discount the cash flows by 10.686%, I have almost an NPV which is actually equal to 0, which means that 10.686% is actually my IRR. Okay, IRR, or the internal rate of return that I am earning when I'm investing this bond when I'm investing in this bond by buying it at the current market price of 900. Okay, but again, the key, this IRR is also known as YTM, but the key thing is this is your rate of return if you hold this bond up to maturity. Okay, you have to hold this bond for 5 years, get the coupon rate and the face value. Only then your return is going to be 10.686%. Okay, that's it for this video. In the next video, I will be covering the method 3. And of course, sorry, the most important thing, obviously, you're not required to do this in an examination with a pen and a paper. This is not at all feasible, just increasing it by 0.5%. You'll probably take half an hour doing this sum itself, right? What the ICAI generally does is, of course, we have a simple method 3. Okay, you can use the input of method 3 in method 2. Forgetting method 3, ICAI may sometimes give you the present value factors at 2 discount rates. This is what it used to do even at IPCC level, if you remember. Okay, in CA inter level, it used to give you the present value factors at 2 discount rates. Say it will give you the present value factors at 10% and 11%, or 10.5 and 11%. Okay, it will give you these present value factors. And by giving you these present value factors, it is indirectly telling you that your IRR is actually going to be somewhere between 10.5 and 11%. Okay, so what you would be doing in the exam is, you would just not be doing the first part of it. You would directly be solving this portion. And then you will realize that, and then you will have to basically continue with this solving the sum in the same manner. Okay, like when you increase the discount rate by 0.5%, your NPV is going down by 17, and blah 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 blah, and blah 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 blah, and then you will finally calculate the YTM of 10.686%. This is how you were used to calculating IRR in capital budgeting. Okay, generally for CA final calculation of YTM, the institute does not give these discount rates, because you can first calculate the YTM using a simple method, which is method 3, which we will be discussing. Use that method 3 input into calculating the exact IRR using the trial and error method. Okay, you will probably get a broader picture or a clear understanding once you actually also see the next lecture, where I will connect all the dots. Okay, so but this is basically not the examination approach of how you will be required to calculate YTM. This is more for you to understand. Okay, that's it for this lecture. Thank you guys. Bye.